Hi, this is February 3rd. This is the third session for the DePaul University Financial Planning course, number 111, which is the introductory course called Fundamentals of Financial Planning and Insurance Planning. And a couple administrative things. Number one, again, anybody that has the ability to come in with a microphone, you're free to join us in our discussions or our chats. I look forward to that. I really encourage it. If not, I will be checking the chat box on a regular basis. Those of you that email me questions and or are picking this up on the from the archive and you have questions, if you email me so I don't have to try to go look up phone numbers, please add your phone number at the bottom, because sometimes it's easier for me just to call somebody as opposed to try to figure out what will take 10 or 15 minutes to write answers. Sometimes I can just respond in 2 minutes and save me some time. Number one. Number two, technically the quizzes are due the week after we finish the unit, before class, so I can check the grading. What I want to be able to do is if anybody ever has a question on a quiz question, I will cover it at the beginning of the class, especially if you email it to me. There are a couple questions that are going to be very challenging, and they're designed that way. And don't get overly frustrated or say, boy, they're picky-unish. It's partially what we're trying to do to make sure that you're prepared for the comprehensive exam. There are a couple questions that I'm basically, even though you might get an incorrect score, you're still going to get a credit for that question when I grade them. Because whatever your score is, if it's one of the questions I'm adjusting, everybody gets credit, and usually in the course of the semester, you're going to end up getting 2 or 3 extra questions free. So again, after we finish the unit, so the quiz for unit 2 is really due a week from tonight. The quiz for unit 3 will be due a week from Wednesday night. I'm saying units, not sessions, because I want to finish the unit before we go into the quiz. So I think that answers that. One of your colleagues sent me some good questions. I want to clarify it from slides week number 1. Unfortunately, I can't go back and reload them, so I'm going to give you the information. Under content, there's extra material for almost every single week. The readings that are assigned on the syllabus is what is important for you to read. Unless I mention specific things under content, which I will do tonight, then you can look at it as it comes due. So the purpose of the additional information, additional articles and so forth under content is to give you a feeling of what's going on in the financial planning world and in questions people have. This weekend in the Tribune, there were 2 articles of interest, possibly 3, on overall debt, retirement needs, and so forth. Last week I was able to get the links up. I haven't been able to get it done yet. I will try, but if anybody has access to both the real estate section and or the business section of the Tribune, there's always some interesting things on this from the Sunday issue. Slide number 79 for lesson 1, unit 1, talks about principal, interest, taxes, insurance. Housing costs should not exceed 28% of gross monthly income. Gross income. That means that if your total housing cost for principal, interest, taxes, insurance is greater than 28%, it's out of the ratio. It's probably not going to be approved under the that ratio. Now, back in 1999, 2002, 2006, mortgage brokers were telling me that if it's close, even a little bit excessive, if people have enough assets, they can still get approved. In today's world, even if you have pristine credit, they're going more and more to the ratios. So one of the ratios for housing cost is gross income. One of the other ratios would be total debt. But again, on slide number 79, I mentioned there's a thing on slide 79, 80, 81, and so forth, where it talks about the new ratios under the new Consumer Protection Act. where now they've extended that to 43%. And there's this chart on slide 81 that says if housing for the Hardings, their income at $100,000 is 24%. That was in the ratio. At 24%, at $75,000 of income, it doesn't fit because now it's at 32%. But if you notice at the 43% level, it actually would go about $57,000. To the best of my knowledge, currently they're testing the 36% and 24% rule. So the reason I gave you the other information is that's what went into effect as of January 1st. I don't know what's going to be tested when you go to take the comprehensive exam. So that should clarify it. You have to be at or below those ratios to qualify. So 2 ratios are on gross income, and 1 ratio is on net income. And I have them listed on the appropriate slides, so you should be able to figure it out. If you have any other questions on that, please feel free to send me an email and I'll try to clarify it again. The other question somebody had was referring to the book 5.35 and table 5.5. There may be a mistake there because I don't think they're including the housing cost. They're only including the automobile, and they assumed what the mortgage loan would be. I'm going to have to double check that, and I will try to get an answer for you that's a little bit better, because if you do add in all the other debt, it might be above that ratio, and I have to verify that. I couldn't get an answer from the publisher today.
Excuse me, Howard, what table was that?
The student that sent in the question was table 5-5.
Thank you.
Of the textbook, the Lamone textbook, table 5.5. And that also would coordinate with pages 5.35, 5.36. And again, I did send an email. I haven't gotten an answer yet, and I will get clarification. Al, I hope you can hear me okay. I see you just joined the session. Just let me know if you can. Now, some of the other items I put up under additional content, I just want to let you know about. There's an Excel spreadsheet that says financial planning software products. People have asked me frequently what are good software products to use for financial planning. So I put down what was published in Investment News last December, the most frequently used financial planning software packages. There is one that is called Financial Profiles that used to be very prevalent. It's actually now owned by the same company that owns Naviplan, but that is not as detailed as MoneyGuide Pro, eMoney, Workstation from Morningstar, or Naviplan. And then the last one there is people setting up their own along with a company called Otis Financial Logics. I'm just putting it up because people asked for it. We are going to be talking a little later tonight about 529 plans and college funding. There is a grid, an Excel spreadsheet, that has a couple websites as well as the top 20 529 plans that are on the market today. Again, this is from the same source. And then there's a third grid that I'm going to refer to, Excel spreadsheet, that I made as a study guide for you that's called Revised Number 3. Information may change due to congressional action. It's usually revised around the July 1st every year. It says Overview the Student Financial Aid Programs. The reason this is not on the handout or on a PowerPoint is it just doesn't work well. There's too much information. So I'm going to explain that to you. And all of this stuff is found under additional content, I believe, for tonight's or actually last session. I think that clears up most of the questions. Before I move on, is there anything anybody wants to ask about the first 2 sessions? Okay, well, one other administrative thing. As part of the online program, I'm supposed to have some discussions. And one of the discussions was supposed to have been to introduce yourself, and 3 or 4 of you were kind enough to put the information up on the discussion board, and I had most of you email me the information. If you still have the email and you just want to cut and paste it, fine. If you just want to add a couple sentences, fine. But technically, I was supposed to have you do that on the discussion board. The reason I didn't was it wasn't ready when we first, or I didn't think it was ready, but it actually was, when I first sent the email. In addition, there's going to be a discussion that I'm going to talk about probably next time, which asks the question, what is it about money that's important to you? And the purpose of this is to learn to ask open-ended questions and come up with answers that would be unique to the people you're talking to. A financial plan that is a book that everybody gets the same information except what's your net worth and what's your cash flow really isn't a comprehensive individual plan. But you really can't, in my opinion, come up with a comprehensive individual plan if you don't know what makes people tick. So there's a question up there already that's called, what is it about money that's important to you? And you're supposed to answer that as though you're the client, not some esoteric thing as though you're an advisor or you're a financial analyst. If you're a client and you're being asked the question, what's important to you? It might be being able to have less stress. It might be being able to send your kids to college with no debt. It might be being able to take a vacation once a year, and take a 3-week cruise someplace you've never been. Anything you put down is fine, and I'm going to try to respond to it. And the other issue is each of you is supposed to respond at least 3 times to some of your colleagues. Again, the purpose of this assignment is to get you to think about money in an open-ended manner. There's no right answer, as well as to build some relationship with your colleagues so you have a better understanding of how to ask questions. And I'm going to respond as much as I can, but that's just, some of you already seen it. So again, before I actually get into tonight's session, are there any questions? I'm confused because I saw a hand go up, but I don't see anybody asking anything. Okay, I don't see any question, but somebody's hand did go up. Let's talk about, I'm on slide 56, Unit 2, slide 56. So, unless anybody has a question on the material from the first session, which went up to using the initials, which was, I think, slide 55 when we had Sally sell high. If there's no one that has any questions, I'm going to start with slide 56. FINRA, the Financial Industry Regulatory Authority, is a combination of what used to be the NASD and the New York Stock Exchange regulatory body. When the New York Stock Exchange demutualized and became a publicly traded corporation, they no longer could be under the same regulatory regulation of their own self-regulatory entity. So what happened was they their information and their duties were merged into FINRA. FINRA used to be the NASD, and now it's the Financial Industry Regulatory Authority. If you see an old test question or something referring to the NASD, remember that's now FINRA. One of FINRA's jobs, and it is not a governmental agency. FINRA is a quasi-governmental agency, which means it works hand in hand with the Securities and Exchange Commission. One of their main duties and functions is to help provide regulation and testing. It's to help make sure that the people that are registered have taken some competency and certain things are done on a regular basis so they are familiar with what they're doing. Excuse me. So FINRA says you have to take some classes. You have to take some licensing or registration exams. Some broker-dealers refer to it as a registration. Some will call it a license. However you want to phrase it, it means the same thing. Each exam permits you to work within certain products in financial services. I'm not saying you should take the exam. I'm not saying you shouldn't. I'm not saying you should sell on commission versus be a fee-based planner. I'm just saying if you are going to work and you want to sell a product, you need to take the right exam. The Series 6 exam is a registered representative securities exam for items sold by prospectus. New issues, items sold by prospectus. What does that mean? That means that open-ended mutual funds, and for those of you that don't know, there's two kinds of mutual funds. There are open-ended, which means there's new shares created every single time someone wants to buy. And there are closed-end mutual funds, which when they're organized, they're sold by prospectus, and then after that, they trade like a stock. When anything is sold by prospectus, which means a mutual fund, closed-end or open-end, unit investment trusts in organization or registration, variable annuity and variable life insurance, that is what you can sell with a Series 6. Once the closed-end fund is publicly traded and trades as a stock, because there's only so many shares issued, then you need a Series 7, which is a general securities examination, which covers stocks, bonds, options, municipal bonds, all kinds of things, and all the items that a Series 6 trades, but not futures. Futures would be traded with a Series 3, or if you're only trading the indices on the exchanges, that would be a Series 31. Options would have an option principal, which would be, I believe, it's a Series 10. You're not going to have to worry about that. But the Series 7 will let you trade stocks, bonds, options, and all kinds of other things based upon that registration. The Series 63 is what's called the Blue Sky regulation, which is for the different state requirements. So Illinois would have its own test, and Indiana, Wisconsin, Ohio would have their own tests. And those Blue Sky registrations would permit you to trade or buy or sell either with your Series 6 or with your Series 7 what you are otherwise licensed to do. You can think of the Blue Sky Series 63 as, right from wrong. You know that your client comes first. You know you can't front run the orders. It's basic right from wrong. The Series 65 is called an investment advisor exam, or a registered investment advisor, or an investment advisor representatives exam. If you already have the Series 7, you can take the Series 66. Now, some firms still require Series 63 regardless of whether you have a 66. So what is, I'll answer your question in a moment, Carl. The 65 or 66, there are firms that will require a 63 regardless of the situation. Other firms will say that if you have the 66, you don't need the 63. The FINRA website says if you take the Series 7 and have a 66, you don't need a 63. But again, some firms will require you to have it anyways. The question that's just been sent up is there a series that best aligns with the CFP? Yes. If you want to be fee only, you want a 65 or 66. Some states will allow you to be fee only if you're a certified financial planner and have passed the exam and can use the credential and not have to take the FINRA exam. Other states require the exam. By the way, Illinois, to my knowledge, does require it. I will also tell you that technically investment advisor representatives and registered investment advisors are registered through the SEC, not through FINRA. So that is a registration through the SEC, not FINRA, if you get a quiz question. There are people, on the other hand, Carl, who say, I want to be able to be fee-based, so I'm willing to take fees on certain things, but if an opportunity comes where I can earn a commission, I'm willing to do that. Then you want to also have the Series 6 or 7. Does that answer your question, sir? Okay, again, if anybody has questions, you'll let me know. I'm more than happy to try to clarify. The security representatives, once you decide that you are going to get registered, this is some administrative things that might be tested. You have to fill out what's called a U4, and that's submitted to FINRA. The U4 is like 20 or 30 pages. You can do it online now, which is wonderful, because when I did it years ago, you had to fill in the same information on the top of every page: your name, your address, your date of birth, your social security number, the exam you were taking, and a couple other things. You had to fill it in on the top of every page, and then you had to go and answer all their questions. Now it's all done online, so things that have to be pre-loaded are pre-loaded. Once you take and file the U-4, then you take the appropriate exam and you're given a central registration depository number. So if you know someone's number, you actually can go to Broker Check on the FINRA website and look up information about a broker. Have they ever had a complaint? Have they not had a complaint? Who are they currently with? Who were they used to be with? What registration do they have? Now you can do that if you know someone's full name, or you can do that if you know their number. It's called Broker Check. The investment advisor exam, again, is a 65 or 66. Certain states will accept the CFP designation in lieu of the exam. I believe Minnesota does. I believe Illinois does not. The 65, most states require that for either the registered investment advisor or for the representative. The difference is, are you the firm or are you under a firm? And it indicates what are the federal and state laws, what's market, and how money is done. And again, the 66 is you have to be holding a Series 7. If I'm going too fast, let me know. And just so you do know, if we have enough time tonight, I did load in some additional material that you might find helpful. When I took my comprehensive exam, and in your textbook, I think it's chapter 10, they discuss insurance registration, licensing. And under the federal Constitution, there's a clause that says the federal government has the right to regulate items for interstate commerce based upon the Constitution. Anything dealing with interstate commerce. Now, what does that really mean? It means that insurance sold from one state to another, whether it's property casualty insurance or life insurance or whatever, is interstate commerce. However, the federal government under Public Law 15, called the McCarran-Ferguson Act, says the federal government has the right legally to regulate all insurance products, but it is ceding that right back to the states as long as they do it to promote the public interest, fair competition, and monitor it. So for many years, the states have been the regulatory entity, which means if you need an insurance license in the state of Illinois, you take the Illinois test, and then you may have to re-register and pay an additional fee for the states of Ohio, Texas, Indiana, Wisconsin. The law says that if you are dealing with clients in a state and you're doing business in another state, you should have that additional registration for that state. If, as an example, you will have a Series 6 or 7 and you're doing securities business, you want to sell a variable annuity, you need the insurance license as well as the securities license for that state. Now, there is some reciprocity, but you still have to pay extra fees. So what does this really mean? If you get a test question that talks about security regulation, that's not done by the McCarran-Ferguson Act or Public Law 15. Insurance would be. If you get a test question that talks about insurance, think about this law. Now, what's happening also right now due to the American Affordability Health Care Act, there's a provision that the insurance for health insurance might become licensed or regulated at the national level. That would have a major impact and a change in what's going on. So just pay attention to that. Currently, insurance products are regulated at the state. It also provides for the different state departments to regulate insurance through the commissioner, the administrator, the superintendent of insurance or financial services. As it says here, usually that's a gubernatorial appointment. But the federal government does regulate insurance and financial services through other entities, such as the IRS and the tax code. That's where you have COBRA, the Consolidated Omnibus Budget Reconciliation Act, that has continued health insurance for groups of people where they work for a company with 20 or more employees. That's under COBRA. ERISA, the Employee Retirement Income Security Act of 1974, says you can't favor highly compensated individuals or the bosses. Other regulation says you can't favor highly compensated people and exclude others. You have to basically be non-discriminatory if you want benefits. The Federal Tax Code also, and the Department of Labor also regulates insurance products. This item, slide number 60, speaks about the job of the commissioner. The job of the commissioner has always been to maintain licensing, make sure people are competent, make sure they take their continuing education, also to monitor the different companies and institutions doing business and make sure that they are solvent and they're audited. In all honesty, one of the problems because of the financial issues going on around the whole country is in many cases the departments of insurance don't have enough people to actually go and audit as frequently as they used to. What about continuing education? Please remember, each state requires you to have different continuing education requirements if you have an insurance license. Currently, the state of Illinois says every 2 years, when you renew your license, you need 24 hours of continuing education approved, of which 3 hours must be in a live, face-to-face classroom on ethics training. Now, that's a little different than the regulation for the Certified Financial Planner designation, which says every cycle you need 2 hours, but it can be online. The insurance commissioner also will make sure that you have easy to understand policies. They are going to enforce competition and monitor premiums, but that doesn't mean that they're going to say what's fair or not, because companies can determine how much profit they have. And if a company really doesn't want to sell a product, they can just raise the rates and make it non-competitive. I see one of your colleagues keeps coming in and out of the session. If you're having problems, please let me know. And again, if you're having problems, you may want to check using Google Chrome or Firefox as opposed to Internet Explorer. The insurance commissioner will get complaints from the consumers and handle insolvencies. There are some terms that you might get tested on either for the CFP exam and for a registration or licensing exam. I want to go through several of them. A couple of them are not listed here. Twisting. Twisting says, I'm going to encourage you, the consumer, to replace your policy by not necessarily telling you the truth and maybe even using scare tactics, such as, were you aware of the fact that the policy you have doesn't provide for, on your Medicare supplement, does not provide for blood transfusions? Quite frankly, Medicare supplement policies usually do, but not all. Are you aware of the fact that, this insurance company, you don't have the best product they could have? Or maybe we could get you a better rate for your term insurance if you reapply and drop the other policy. That's twisting. I'm really doing it for my own benefit. In the securities world, that's churning. I'm buying and selling mutual funds or stocks or whatever more for my benefit than for an economic reason for the client. Both of twisting and churning are illegal, if not at least immoral. Rebating says, I'm going to give you an economic incentive to do business with me because I'm going to give you back some money. I'm going to give you a new TV, or I'm going to buy you tickets to the Cub Sox interleague play. That's a rebate. That's also illegal. Selling away. It's not on the slide, but selling away is a huge thing for broker-dealers. That means they haven't vetted the product, the insurance company, the mutual fund, and you're going and either helping someone do it through someone else or you're selling it around them. And the reason that's a big deal is in the event, ladies and gentlemen, something goes south and they lose money, they're going to sue you and every other deep pocket that's available. So those are three big terms that might get tested. There are a few more I'm going to cover. As a matter of fact, I'm going to cover one of them right now that's not on the slide. It's called insider trading. Insider trading says acting upon non-public information is a no-no. Actually, it's acting upon immaterial non-public information. If I call up all of you and say to you in class that I know for a fact that International Widget Corporation is going to be merged with the Greater Widget Combine, and if you own International Widget, you're actually going to get a 30% premium when this comes due next week. By telling you that isn't insider trading. It's if anybody acts on it that it becomes insider trading. Material, non-public information. The action means that the person who gave the information and the person who received it are both guilty of insider trading. Even if I, the person acting on it or giving the information, never make a penny. I don't have to make money to be guilty of insider trading. Selling away, I've already discussed. Insider trading, fraud, or anti-money laundering. These are all issues that are of high importance today and that are frequently tested and things that the regulators are looking at. Insider trading is a biggie, acting upon the non-public information. Think about what happened to Martha Stewart. She was able to mitigate a loss. She saved something like $250,000 or $300,000, and then she went to jail because she, in my opinion, got very bad legal advice. Because if you think about someone who was spending $1 million a year to have all of her taxes and forms done, not to just pay up and be done with a $250,000 fine didn't make sense to me, but that's what she did. So the other thing I want to talk about is not only insider trading. There was an article in the July 2010, I believe it was, I'm sorry, July 2012 issue of Fortune magazine that was titled "Sex, Lies, and Insider Trading," and it spoke about a woman who admitted that what really pushed her buttons was dealing with high affluent people in power of corporations and transmitting information that no one else knew about so that they could all gain. And it's a very interesting article. Actually, part of that was also on a CNBC American Greed situation, where some big hedge fund owners and operators were guilty of using insider information provided by one of the guys who was on the fast track to become the next CEO of IBM. So these things are looked at. It's not just the Madoffs of the world that the government goes after if they can validate it. And today with computers, they can see if you've been trading options positions greater than what there should be. So again, insider trading, twisting, rebating, churning, anti-money laundering, selling away, fraud, violation of the Patriot Act. All of these things, especially if you're taking a registration exam, are highly tested. Financial institutions are intermediaries where money is moving between point A and point B. It could be a checking account. It could be a bank account. It could be making a loan. Please remember that under FINRA and the CFP board, for you as a registered rep, an investment advisor representative, or a CFP to lend money to or borrow money from clients is a no-no unless it's a family relationship, and then you should get it in writing to protect yourself, and or unless it's your normal business. You as an individual, it's not going to be your normal business. You representing Howard's International Bank for Investments, or Howard's Illinois Bank, whatever you want to call it, if that's our normal business is lending money, that's okay. But I, as a financial advisor, financial planner, it's not my normal business. It's going to be a no-no. Banks are usually regulated by the Fed. Now, I have to be specific here, ladies and gentlemen. If you get a test question that refers to the FRB, the Fed, the Federal Reserve Board, it's all one and the same. Banks are usually regulated by them. The Federal Deposit Insurance Company, the FDIC, they used to ask questions about what is the appropriate amount of FDIC insurance, or what is the maximum amount. There's actually a worksheet under additional content if you want to look at it. You can go online and check what the limits are. We're going to show those soon. But remember, when you're looking at the Federal Deposit Insurance Corporation and or SIPC and or anything else, pay attention to what the current regulations are for the maximum. And remember that the Comptroller of the Currency also regulates banks. Some of the banks are state chartered and still come under the FDIC because they're the Federal Reserve because they're under the FDIC. So be aware that banks can either be federally chartered or state chartered, and you have to figure out what's right for you. Savings and loans, sometimes referred to as thrifts. If you remember the movie from around Christmas time, It's a Wonderful World, was it A Wonderful Life? I forgot the name of the movie with Jimmy Stewart. They were in the old building and loan. Their job was to primarily help people get mortgages. Today, most of those building and loans, savings and loans, are now functioning as banks anyways. They have their own insurance to protect depositors. So, and sometimes they go through the Federal Home Loan Bank Board. So there's the FDIC, and there's the FSLIC, and then there's also one for credit unions, and a different one for investments. Currently, the FDIC and the institution known for savings and loans and the institution for credit unions and SIPC all follow the same guideline. You're allowed $250,000 of insurance per account title per institution. So if the question says you have an account at Chase, Bank of America, Fifth Third Bank, downtown Chicago, you have a second account on the north side on the Gold Coast at the same company, you have a third account out in Oak Brook, a fourth account in Glenview, and a fifth account in Homer Flossmoor, you only have $250,000 of coverage per account title. So Howard Sorkin has one account title. If it's an IRA, I can have another $250,000, but that would be for, and my understanding is all IRAs would fall into that category unless all traditional IRAs. A Roth IRA is a different category. So be aware of how the test question is worded. Even if it says Sally and John have this amount on deposit at their bank, and be careful how you read the question. If the question says they have $185,000, how much is the maximum amount of money on deposit they can have, or what is the maximum amount they can have for FDIC insurance at that institution? It's not the $185,000, it's probably the $250,000. So read the question carefully. If I'm going too fast, let me know. Okay, somebody sent in a question. What if I have traditional IRAs in two different brokerage? Well, I'm going to clarify this. If you have a traditional IRA at, let's say, Bank of America, and you have a traditional IRA at a different bank, you have two different FDIC insurance amounts. If you have a traditional IRA at Merrill Lynch in either a stock or even in cash, that is a different SIPC amount than you still would have an IRA at the same Bank of America because it's the same holding company, but it's actually a different corporation. You would have it for another $250,000. If, however, you have IRAs at three Bank of Americas, then you only get one $250,000 FDIC insurance. Does that clarify? You're welcome. I'm glad I was able to help. I'm now on slide number 56, talking about certificates of deposit. Very important you understand what laddering of certificates of deposit mean. Typically in a normal yield curve, the longer you go out on the cycle, the more interest you're going to earn because you're taking more risk that your money is tied up. One of the issues with CDs is if you want to get out early, you want to cash in early, there's going to be a penalty, which usually is 6 months worth of interest, or a minimum of so much. Be aware of the fact that when interest rates are at their normal cycle, that 6 months worth of interest can be expensive. So you have to pay attention to what the maturity is of the CD. Most CDs are 1 month to 5 years or 60 months. Usually they have a fixed interest rate for the entire period of time. Usually You can get them up to $100,000. Above that is going to be called a jumbo, and usually jumbo CDs pay a little more interest. Sometimes you can buy them through a brokerage firm, and they're still FDIC insured, but they're a little more publicly traded. But pay attention, because CDs typically are considered cash and cash equivalents if they're 90 days or less of maturity. Longer than 90 days, but less than a year, would be the next level. Greater than a year would be basically illiquid. So read carefully on a CD and be aware of the fact that some of the banks actually now say, you can break the CD early with no penalty because they really want to keep the money on deposit. CDs are sometimes traded, but again, pay attention to the maturity, and if it's less than a year, it's going to be considered like a money market instrument, but for an emergency fund, they have to be less than 90 days. And I'm going to go over that shortly when we get through emergency funds. I've already discussed this about the credit union. There's a non-for-profit. You join them for some reason. They have the same kind of insurance, and they're primarily making loans and providing deposits, usually at a little cheaper rate because members of the credit union own it. It's a non-for-profit. The main function of broker-dealers is to execute orders for customers and make their trades. It's transactional in nature. Uh-oh, somebody sent me an email or a text message. Give me a second, please. If a CD does not include a no penalty clause and it's greater than 90-day maturity, does that change its characterization? Well, it might in the real world, but not for the test. For the test, it's not going to say there's no penalty clause. I just made a comment, because some people have said to me, what if I have a CD where they say there's no penalty to get out early? For the exam, the comprehensive exam, it's going to be a little more specific, and if it's greater than 90 days, it's not what's used for an emergency fund, which is where the key is, so that's what's important. I'm going to go a little longer, then we're going to take a quick break. So, broker-dealers, when they're acting as a broker, they're allowed a commission. If they're acting as a dealer, they get a markup or markdown because they're buying or selling something out of their own inventory. They're not allowed to get both the commission and the markup or markdown. It's one or the other. Broker-dealers are transactional. Some people refer to them as stock jocks. I don't mean to be derogatory, but usually you have a Series 6, a Series 7, and that makes you a stock jock if that's all you're doing is transactions. SIPC is not the same as the FDIC. It's going to not cover market losses. It doesn't cover fraud, and it doesn't cover commodities. What does it cover? It covers securities and or cash on deposit in some broker-dealer's institution. So SIPC says, I have $750,000 in securities in my joint account. I have $100,000 of cash. The first $500 is covered unless my broker-dealer has extra, and then if they're paying for more coverage, they can offer me more. All accounts are owned by one customer, but again, IRAs are treated separately. So what does this mean? This means that Jack Smith as an individual can have an account. Susan Smith as an individual can have an account. Jack and Susan, joint tenants with rights of survivorship as husband and wife, they can have a third account. Each can have an IRA account. So and if you also want to know what they can do is at a bank or a stock firm, they can even have an account where it's Jack is trustee for Susan, so it's really a trust account, so they can actually get more than $250,000 of coverage at one institution if the accounts are set up properly. The other thing I'll say to you is there are some institutions now, such as in Chicago Wintrust, where they have like 15 or 18 different banks, but they're all chartered separately as separate corporations through the same holding company. They actually have different amounts of coverage at each of their institutions. Here's a question for you. I'm going to make an assumption that everybody online in our classroom tonight has taken some kind of course at school, either high school, grammar school, even college, where you know we have three branches of government. Branch number one is legislative. Their job is to enact the laws, and that will fund the insurance department. The second branch is judicial. They make sure the law is constitutional for either the federal level or the state you're in. The executive branch job is to administer the law. And that's where they're going to appoint the insurance commissioner, sometimes referred to as the financial services commissioner or superintendent. So remember, we have three distinct branches of government at the state and at the federal level. What's a mutual fund? A mutual fund came into being because actually in 1924, I think Mass Financial Services, MFS, was the first company to offer mutual funds. And what they offer are diversified investment portfolios so that people can own usually many stocks with many ideas in them in such a way that they're able to diversify. If you have $1,000, it's very hard for you to diversify if you want to buy 5 stocks, because it's not a lot of shares. But for $1,000, you can open an account and own maybe 100 stocks, or pieces of 100 stocks, or 25 or 50 or 100 bonds. That's what a mutual fund is. And the mutual funds have diversification within them. The fund manager must be registered with the SEC as an investment advisor. The fund manager is considered professional. They have to have an independent board of directors. The portfolio can be stocks, bonds, money market instruments, all kinds of things. They can be diversified. They can be value-oriented, growth-oriented. And they function under one of the acts is called Security Act of 1933, which deals with paper. And that act says, what are we going to have someone list in that Security Act in order to make sure that the public has all the information that they want. Now, I don't know if anybody's ever read a prospectus, but it's not the most exciting thing to read. There's a lot of technical information, and a lot of things that may or may not make sense. And they have the backgrounds of the people, what the philosophy is, how they're getting paid, all kinds of information. It doesn't say, the SEC does not say we approve it. It just says it's followed the guidelines to be registered. The Security Act, mutual funds sold by prospectus are always considered new issues. The Investment Advisor Act of 1940 determines what the manager of the investment advisor is. Now, I'm going to back up here. The Act of 33 talks about people. I'm talking about paper. The Act of 34 talks about the registration of people. That's the licensing exams, the background checks and all that. The Act of 39 deals with debentures and bonds, debt instruments. There's 2 acts of 1940. One is the Investment Company Act, which is sometimes referred to as a 40 Act fund, which is what mutual funds and business development companies fall under. The Investment Advisor Act of 1940 talks about the people that are investment advisors and what they have to do. And then we have the updates in the Anti-Money Laundering Act and the Patriot Act and all the other acts that have followed up to 2013. So be aware of that. We have been going about 45 minutes. What I want to do is take a 5-minute break, and then we're going to come back and talk. Well, you know what? I'm going to finish one more slide. Trust companies operate usually through banks, administered through the state and or federal level. They manage trust funds and trust accounts and provide usually for estate planning, and sometimes they'll answer stock transfers. So we have banks, savings and loans, credit unions. All of these are entities that handle transactions with money. We have stock firms called broker-dealers, and sometimes mutual fund firms that handle transactions dealing with stocks and bonds, and we have trust companies that will handle estates. So now I'm going to take a 5-minute break and then come back going to talk about educational funding and needs analysis. Now, if we have enough time, I've also developed about 20 PowerPoint slides on a basic of Social Security. That's up on the site tonight. If we don't have enough time, I'm going to keep that and just give you the primer at some point, because this is additional content I want you to have. It's nothing that you have a quiz question on yet. So let's reconvene in 5 minutes or 26 minutes after the hour. And when you're back in the classroom, please give me a green check mark or something so I know you're here. Otherwise, I'm going to stop the recording on slide number 73, and we'll pick up here in a moment. Recording again. Welcome back to session 2, Monday the 3rd of February. We are still doing unit number 2. I'm on slide 73. Now, just so you know, ladies and gentlemen, we're going to go through some of these slides relatively quickly, because right now you don't have your calculator, and once you get your calculator, I'm sorry, somebody just sent me a text message where I explained things that are sold by prospectus. Real quickly, all new issues are sold by prospectus. That's called the primary market. The primary market is not trading on a New York Stock Exchange. It's when things are sold as a new issue. So stocks, bonds, mutual funds, variable annuities, variable life insurance, you get a document called a prospectus that outlines all the information about the company, the philosophy, the debt, the projections for income, and so forth. Once you have that information, you can make an educated determination if you want to buy what they're talking about. I don't know too many people who've ever read a prospectus cover to cover before they make an investment. You rely on the summaries, you rely on the trust of your brokers and your advisors. So the prospectus is a legal document that outlines what the investment will entail. And when things are sold by prospectus, a registration of a Series 6 or 7 is required to do that. And a 6 or 7 would also include insurance products such as variable annuities, variable life insurance. And again, if you're selling an insurance product, in addition to the registration for securities, you also need to have a registration to sell insurance in the state you're doing business in. Does that answer it? Good. Okay. Slide 73, Unit 2, talks about financial needs analysis and college funding and how to use the calculator to do this. Number 1, once you get your calculator, come back to the slides just like I talked about week 1, Unit 1, talking about amortization. Come back and learn how to do this. Financial need analysis and the amount of money that you need for education or the amount of money you'll need for serial payments for retirement is stuff that would be tested on the comprehensive exams. So you need to understand how to do this kind of calculation. Don't get hung up if you're having trouble doing calculations. It's a small part of the course and a small part of the comprehensive, but it's things I still need to cover. So, and I'm also going to tell you that once you become a financial planner, and some of you in the classroom do work for firms that do planning, you know that you have software packages that do all these calculations. So once you learn how to do it and understand it with your calculator, you're going to be able to have the information you need, and once you know how to do it with a calculator, you can understand the process better and how to deal with inflation and the cost of the inflation. A question just came across, can you use a calculator at the comprehensive exam? Absolutely. If it's one of the approved calculators, the HP, Hewlett-Packard 10B2, 10B2 Plus, 17B, 12C are all approved. There's a Texas Instrument that's approved. And one thing I don't know is what they're going to let you do once they kick over to the online exam that's going to start next November. I don't know if that's going to be built into the software or you're still going to get your calculator. But you will be able to use a financial calculator. You will not be able to use a programmable calculator where you can program the formulas as of right now. Does that clarify it for you? Okay. The next couple slides, I'm just going to go over quickly. It's how do you figure out how to inflate the cost of college education. Now, I said in session 1, inflation is here, and it means different things to different people depending upon where you're at. If you're the general public, you might use the CPI, the normal CPI index. If you're a senior citizen today, worried about health insurance costs and so forth, there's a new CPI-S that's coming out. If you're talking about being a student or having to help pay for somebody's in college, if the CPI rate or the inflation rate is 2%, you might want to use 7 or 8 because college costs are going up at a higher rate. So you have to determine what number you're using. When I do a financial plan for somebody, the plan, I will actually tell people, I'm assuming education is going up at 7% a year or 8%. I never assume it's going up any less than 6 because I get a number that's not close enough to where it's been over the last 15 or 20 years. What I want you to do is go through Unit 1, the amortization slide, and Unit 2, the financial needs analysis slide here for inflating college costs. And here it talks about the first step, and it actually walking you through what you need to do. And then the second step and the third step. So when you get your calculator, and we're going to work a little bit on that next week. As a matter of fact, from a show of hands, how many of you have a calculator? You know what? I'm going to clear all the check marks. So nobody has a check mark up. Just let me know if you already have a calculator, whether it's the 10B2 or anybody else's. I don't care. I don't care if you're comfortable with it. I just want to make sure you have it available for next Wednesday. Okay, if you don't have it, try to have it for next Wednesday. Either you can order it from Amazon or you can go to Best Buy or someplace. It's around $35 to $40. If you currently have a calculator you like, use it. Good. Final step here is how much you have to save per month. The question may also have to say, I've actually seen it where there was a question where you had 2 children in college, and they want to know how much you have to save for both children if you want to have all of the college expenses paid for by the time each one became starting college. Again, I'm going to try to go over these on Wednesday. Are there any questions before I move on? I just cleared all the check marks and X's. Okay, if you have the 10B2 or the 10B2 Plus, wonderful. That is the purpose, an OTI. No, don't get a new one. If you know how to use the OTI, that's fine. If you know how to use a 12C, it's fine. Okay? The 43-question worksheet, somebody asked me this, are you responsible for the worksheets? The only one that will be turned in via online is going to be the 43-question time value of money. Once I know you have it, if you've done 80% or more of the problems, whether you're right or wrong, I'm not as concerned. But if you've done them and showed me that you've had the steps, I'm going to email you the answers, and you should get that prior to the midterm. So that's your incentive. It is checked in as an assignment, but it's not graded. And students have said, well, if I'm doing the work, why isn't it graded? Well, if you're a finance major or have been doing it using calculators as your career, you're probably going to get a real good grade. But if you're not used to it, I don't want you to have to worry about the grade because that puts you at a disadvantage. I want you to do the process. And if you look at the 43-question worksheet, you'll see how the process works. So what you're going to do is email me or fax to my office either the answers or all the sheets. And once I see it's there, I'm going to make sure you get a copy of the keystrokes and the answer sheet for the 43-question time value of money. Are there any questions? before I move on. I'm sorry for drinking so much water, but my throat is really dry today. So I don't mean to be rude. One way of funding college, and the way that was most common when my children were young, was to use a uniform gift or uniform trust to minors account. That said, I was the custodian for my child's account. So each of my children had their own account. I could put in as much money as I wanted for my children. If Grandma and Grandpa wanted to give them a gift, they could each give them up to they could each give them up to $14,000 per child, or $28,000, with no gift tax and no need to file a gift tax form. If you look at what it meant, is it says transfers of present interest gifts. So it's automatically the child's money, and it's totally vested to the child at the age of majority, which in the state of Illinois and many states is the age of 18. Uniform gift and trust to minors accounts might reduce financial aid depending on how it is structured. One of the things that might be tested is what's on these next couple slides. The beneficiary for a uniform gift or trust to minors account never changes, always that child. If the child dies prematurely, it's in that child's estate. It used to be that there was no tax on a uniform gift to minors account, and if there was a tax, it would be on the child rate, which was obviously lower than mom and dad's, especially when mom and dad were in a 40 or 45 or 50% tax bracket in the 70s and 80s. So now the government came back and said, we're losing too much tax revenue. So they came out what was called the kiddie tax, and the first kiddie tax said, if your child is under the age of 14, we're going to do this. And now it's if the child is under the age of 19 or under the age of 24 if a full-time student. Now this changes each year, these calculations, so I'm giving you on the next couple slides the guideline. And before you go to take the comprehensive exam, check to see what the number is, A, for the gift tax exclusion, and B, how the kiddie tax works. So it says if the parent's marginal tax bracket on investment income exceeding $2,000 is where the parent's tax bracket's important. Under $2,000 of investment income, it's going to be taxed at the first $1,000 is the child's deduction. The next $1,000 is at the minimum tax rate of, say, 10%. Now, I hope the slide was corrected. I'll find out in a second. I've already discussed this. Oh. Why is this way? So here, the difference between a trust and a gift to minors account is the trust to minors account can also use real estate funds. Uniform gift to minors goes to the child at the age of majority. The custodian account and the trust to minors you might be able to delay it to age 21. I had a friend of one of my sons who, when he was in high school, mom and dad had put away almost $90,000 for education, and little Johnny basically quit college after one semester, followed the Grateful Dead, and went through $90,000, much to the chagrin of his parents, and mom and dad couldn't do anything about it because it was the child's. Now, this is the example for the kiddie tax. Ashley is the beneficial owner of a uniform trust to minors account that generated $3,000 of investment income or interest in 2014. Mom and dad are in the 28% bracket. How is this taxed? Well, $3,000 is the income. The first $1,000 is the deduction. The next $1,000 is at 10%. So that leaves $100. The next $1,000 is at 28%. So with the kiddie tax and everything else, it's $380. If it was all in mom's and dad's name, it could be another 28% or $560 on the first 2,000. So this is the advantage. Does everybody see how this works? Give me a check mark if you understand what I'm saying, please. Please, again, just make sure, I know one of you might be having a problem, but please make sure you understand how this works. I believe there's a quiz question. And again, if you get a test question, it could be on the kiddie tax, or it could say, if it was all in mom and dad's name, what would be the difference in the tax? They can ask questions all different ways. Now, how many of you are familiar with what's called a 529 plan? I just cleared the check marks. So how many of you are familiar with 529 plans? About half the class? Okay. A 529 plan is a college savings vehicle. There are two kinds. One is called qualified tuition and one is prepaid. And what you have to be aware of is, unlike the Uniform Gift to Minors account, mom and dad, or whoever the owner is, it could be grandma, grandpa, aunt, and uncle, whoever the owner is, they control the account. Under a Uniform Gift to Minors account, ladies and gentlemen, the money is the child's at age of majority, and technically is the child even before majority. You can't spend it if it's the child's. Under a Section 529 plan, which is an Internal Revenue Code section, what happens is the money is technically the participant, the owner, which could be mom, dad, grandma, grandpa, or a trust, and the beneficiary is the child. So little Johnny is the beneficiary, the owner is grandma, grandpa. Little Johnny is the beneficiary, and if little Johnny, who is the most wonderful human being at the ages of 6 months, 2 years, 3 years, 8 years, 10 years, 12 years, and at age 16 becomes a pain in the neck, and at age 19 doesn't want to go to college, you don't have to give them the money. You control how that money goes. So the Section 529 has become very popular. The downside under current regulations in Section 529 is it has to be through some program. Usually mutual fund companies have it. If you look at that grid online, it shows the top 20 and talks about the 529. There's a website called Saving. I'm going to look it up. I never remember if it's called. It's savingsforcollege.com. I'm looking it up right now. And there's another website called 529guru.com. 529guru.com and savingforcollege.com. They both talk about 529 plans. Almost every major mutual fund company will have that has a 529 plan. You can look up their plan online. Vanguard, American Funds, John Hancock, Fidelity Funds, BlackRock Funds, MFS, Oppenheimer, Franklin Templeton, J.P. Morgan, all of these, TIAA, CREF, T. Rowe Price, they all have different trusts that they coordinate their plans for. So you can have all kinds of selections. What you want to make sure is the trust permits you to send your child to any university they want to go to that they can qualify for, whether you're a resident of that state or not. Because what happens if you're living in the state of Illinois and all of a sudden dad gets a transfer and now you're in the state of California, but the plan you're in says you can only go to school in the state of Illinois? You may not want to go there. So you want flexibility. The 529 plan provides for flexibility because you have tax-deferred growth on the earnings. You don't pay any tax on the earnings until you take them out, and if you take them out for educational expenses, which is broadly defined as tuition, room, board, fees, books, it might even, in some cases, be defined as travel or commuting costs. If you take it out for educational expenses, there's no tax on the gain as long as it's for higher education, past 12th grade. The child does not own the asset, so it's an advantage if you have little Johnny that was like the young man I talked about, it's an advantage because he can't take or she can't take the money and spend it. And it, depending on how it's set up, it might be not held against you for college aid. Prepaid tuition plans say if you pay the money in advance, there's no other problem, and your tuition's paid for. Many of the states that had prepaid tuition plans stopped having them because with this current market and the volatility since 2007 and low interest rates, their performance didn't allow them to do it. In some cases, the state legislatures had to come back and bail out the plans. In other cases, the states don't have, or the legislatures don't have that money. So prepaid is one way of doing it. Qualified plans say that you're going to be putting money in on a regular basis, and then you have some other restrictions. Typically, the trust is sponsored by a state. Illinois has the Bright Start program, and they also have a prepaid tuition program. The owner assumes the risk of investment, just like anything else. It's considered an asset of the parent or the owner, not of the student. No reduction for benefits for out-of-state school if it's done right, so it doesn't matter where you go. The investments are in mutual funds primarily. Some of those could be target date funds, some of those could be time date funds, some of those could be based upon risk tolerance. And it says that you can transfer it once a year, you can do other things with the money, you can set up different plans. The key is if you need the money because of a financial reversal, grandma and grandpa, well, let's say grandma and grandpa were worth $20 million and they invested all of their money with Madoff and Stafford and now they're broke, they can recapture the money in the 529 plans that they have given to their 10 grandchildren, and they may have given their 10 grandchildren in 2012 or 2013 or whatever the year was, the maximum gift tax they could have done. So let's say the gift tax back in 2007 was $12,000. So 12 and 12 is 24 for grandma and grandpa. 24 times 5 would be somewhere about $130,000. So they could have had $130,000. They were worth $20 million. They had 10 grandchildren. They transferred $1,300,000 out of their estate for federal estate tax purposes. Where it says presumes the maker survives 5 years. Each year the people live, that 1/5 is out of their estate and is now in the plan. As long as they don't put in more than what the gift tax exclusion allows, there's no tax. If they need to recover the money because of their own financial reversals, they're the owners, they can recover the money. So you don't have to worry about recapturing it. They just have to pay ordinary income tax on the gain and a 10% penalty. They have to pay ordinary income tax on the gain and a 10% penalty. However, if you think about it, if they're in financial trouble and the whole market's down 50% like 2008, there may not be a problem or this trouble. So be aware of that. Again, if the child is not the most wonderful child as a teenager, you can transfer the money to somebody else, even to their parents, if their parents want to go back to educate and get re-educated. So the preferable item, but not always perfect, is the 529 plan. Are there any questions before I move on? Okay, I don't see any coming up. Again, go look at the graph that's under other content. Another vehicle that would be for primary or secondary education is the Education IRA, the Covered All Education Savings Account, however you want to phrase it. These are not deductible. There's no contributions after the age of 18, and you must spend the money by the age of 30. You have to follow the deadlines. And usually these aren't very popular, or they're popular, but they're not used a lot, I guess, because people sending their kids to private or parochial schools, they don't necessarily have the advantage of saving the money and without taking it out right away. The other thing regarding the 529 plan, that is used for higher education as long as it's something that's approved by for financial aid. So it could be heating and air conditioning school. It could be beautician school. It could be being a chef. It could be overseas as long as it's eligible for federal financial aid. It does not have to be for college. The other advantage of the 529 plan is the flexibility, the tax deferral, but one of the disadvantages is you basically don't get to invest the way you want. You have to invest in somebody's funds. One of the things that's highly tested will be these phase-ins and phase-outs. I don't want you to memorize them, ladies and gentlemen, because they change every year. But what I do want you to do is be aware that they're there. So it says for an education savings account, if your income as a single is over $110,000, you may not be able to put money into the education savings account. So usually it's the people that have the higher incomes that have the discretionary income to use it. So if you're doing that, somebody else might have to make those contributions. And yes, you can contribute to an education savings account the same year you put money into a 529 plan. Someone just said, is the $500 per child maximum annual contribution accurate? What $500 per child are you talking about? For the education savings, it's $2,000 per child. Where did I say 500? For an education savings account, the $2,000 as of the end for 2014 is the maximum you can put into that account in a calendar year. Does that answer it for you? Okay. For a 529 plan, there is no maximum. Am I going too fast? Please let me know. Educational savings accounts, it shows here that you can use the money for a lot of things: uniforms, transportation, tutoring. There's some deadlines. All funds must be distributed before the person is 30 years of age. There's a grace period. They can be rolled to another beneficiary, just like a 529 plan if you need to. It's important to realize who owns the asset. In a uniform gift to minors account is the child's. In a uniform, I'll get to your question in a moment. In a 529 plan or education savings account, it is the owner who owns it. I believe under the education savings account, you can pick the investment or put it into a bank account or whatever. Again, I've only used it a couple times because most of the people I've ever talked to have the same feeling. I need the money next September to pay for private school. But I believe you have a little more flexibility in the investments in the education savings account than you do in the 529 plan. People can use U.S. savings bonds. Now, it used to be that the owner had to be over the age of 24 and the parent. Now it can be anybody over the age of 24. It has to be a new bond issued, not one that's already existing. And it cannot be issued to the custodian account. It has to be in a account in the name of the person over the age of 24. And then if it's used for education, the interest is not taxable. That's higher education, to the best of my knowledge. This explains how it works. Again, there's phase outs. This one is not for room and board, where the 529 plan or the covered all would be for room and board. I'm trying to stay closer to the light so you see me a little better. Again, you have to pay attention to the modified adjusted gross income. These are the current limits for EE bonds. And you got to pay attention to that. Don't memorize the limits for this course. Just be aware that for Roth IRAs, deductible IRAs, education funds, and so forth, there are limits. Inflation bonds are issued by the Treasury. They're not marketable per se. This tells you what you want to know. Some people like them for education, especially if there's going to be inflation, because the bond should be worth more. But how does that work? Education tax credits will reduce the liability dollar for dollar for college funding. Now, what you have to be aware of is there will be phase-in and phase-outs. There is under additional content, there is a two-page Excel spreadsheet that's called Overview of Student Financial Aid. You can literally use this as a study guide, and it gives you information with footnotes, and you can update it yourself. I had something like this when I was taking the comprehensive exam, and I just kept updating it and helping my students with it, and that's why it's also online, so you can just use it as an Excel spreadsheet. What you have to be aware of is, if you think about it logically, most of the people coming to you as a financial planner or financial advisor are not going to qualify for most of the financial aid programs. Their net worth is going to be too high, or their income is going to be too high. So you have to be aware of some of these, like the Pell Grant and the Stafford loans. As you're going to see, they're for very low income people, but you have to understand what they are for the exam, because people are going to come to you and ask you questions about these programs. So here it says, students may claim the credit if they're not dependents on the parent's tax return, or the parents get to claim the dependents. You both don't get them. It's one or the other. The American Opportunity Credit is till 2017 unless extended by Congress, and says it's 100% of the first 2,000 and 25% of the next 2,000 for tuition, books, and fees, based upon our adjusted gross income of thresholds. So everyone may not qualify for the credit. And this credit may also, I think that's now where they have, I won't just go down to my next slide. So the credit works in conjunction with the lifelong learning credit. What does that mean? Here it says for lifelong learning you can get up to $2,000, which is 20% of the $10,000 for eligible cost. However, you don't get both. You can't use the same expenses for both the American Opportunity Credit and this credit. Different expenses, different phase-out numbers. Don't memorize them, just be aware of them. And it says if this is for job improvement courses. So many of you that are paying your own tuition, see if you can talk to your tax advisor, you might be able to use the lifelong learning credit for some of the courses you're taking here at DePaul. But again, you can't use the same lifelong learning in the American Opportunity Act. The American Opportunity Credit cannot be used, and it says American Opportunities for the first 4 years. It used to be the Hope Credit. I believe they've been combined into one. The lifelong learning can be for continuing education, graduate school, undergraduate school, and certificate programs. The American Opportunity or lifelong learning may be claimed if you're using Covered All, as long as you're not using it for the same expense. CFP rule of thumb. Taxpayer can't use multiple tax breaks for the same item. And you might get a test question to see if you understand that. There was a test question a couple semesters ago, I was told, that it was like that. Student loan interest, pay attention to the phase-outs, but you are allowed to deduct up to $2,500 per year if you're in a lower income level. And what you have to also remember is the parent loan, the PLUS loan. PLUS would be for parents, and that would be probably the only item where someone coming to you as a financial planner is going to be able to use the governmental program on a PLUS loan. But that also means that mom or dad who has lent the money, they're responsible for paying it back. And there's been instances where mom and dad have lost their houses because they've remortgaged their house to help their students. Their students haven't paid back the money or defaulted, and now they come after the asset that's attached to it. You don't want to let people recharacterize a loan or consolidate a loan between a married couple, because I don't believe that's allowed anymore. But up until last year, I think it was, you could do it, which meant whoever owned the loan, even after divorce, they're responsible. And don't think that that wasn't happening. Remember also that you can't use the same expense for the same student at the same time. You have to pay attention to the phase-ins and phase-out for what you're allowed to. The FAFSA form, even if you have a student that might be getting a scholarship for financial aid, as a sports athlete, they still may need a FAFSA form, even if the income is too high. And the expected family contribution is something you should figure out, be able to figure out. You can go online and learn it. They may ask on an exam, what is it? I don't think they're going to ask you to figure it out. They haven't recently. Before I finish up here, I need to know, am I clear on all this? Because it's somewhat confusing, and there's a lot of material I've thrown at you. So if anybody has a question, I'm giving you a few seconds before I go to the last couple slides on college funding. Okay. Again, the Pell Grant and the Supplemental Education Opportunity Grant shows what it can be. These are for very low income levels. Colleges, when I went to school, you were either a full-time student or a part-time student. Full-time was 12 hours or more, part-time was less than 12. Today there's full-time, half-time, and part-time. So full-time would be 12 or greater, part-time is 6 or greater. I'm sorry, half-time is 6 or greater, part-time is less than 6, I would assume. Income levels, be aware of what they are, and they do change every year. The people you're going to deal with, unless you're working for a credit union or some charitable organization, those aren't the people you're going to be able to talk to about Pell Grants, subsidized loans, PLUS loans, Perkins loans, Stafford loans. These are giving you what the numbers are. The grid I gave you says what's available for graduate level, what's available for undergraduate level, and you have to be aware of that. The PLUS loan, again, is probably the only thing that someone is going to be able to come to you for if they're hiring you as a financial planner. What's available for graduate school? Perkins would be, that's need-based. Stafford is needs-based. Fulbright scholarships, 529 plans, and be aware of the fact there's a lot of affinity scholarships that may go wanting because people don't apply. So that covers the material for college funding and the rest of Unit 2. And I've given you some extra handouts to look at. I told you about the worksheet for the time value of money and to start working on the calculator. Are there any questions at all? Okay, then what I want to do is I'm going to stop the recording. I'm going to take a 2-minute break, and then I'm going to come back and we're going to talk about a little bit about Social Security. Social Security is something. Welcome to February 3rd. This is the session on Social Security, which is some extra material I put together as some overview. Social Security is a real important thing as a financial planner. More and more firms are coming up with their own little worksheets for Social Security. There are entities that have information for you on Social Security. I will tell you that a lot of the insurance companies, mutual fund companies, stock firms are all putting together when is the most beneficial time to take your Social Security check. What about, what's called file and suspend, so your spouse can take your check and so forth. Social Security became law in 1935 under Franklin Delano Roosevelt. He made a golden promise to the American public at that time that these benefits would never be taxed because the government was deferring some of your income so that you would have it for later on as a safety net. Unfortunately, today, Social Security is the largest source of income for most Americans over the age of 65, and for 36% of the population, according to the Social Security Guide published by Mercer in 2013, it provides 90%. It will provide 90% or more of their income, and for 65% of the population, it's the largest single source of income. When Social Security first started, we had like 10 or 11 workers for everybody that was going to receive benefits. Today, we have 2.9 workers, and they're saying that by 2039, there'll be 2 workers for everybody providing benefits. Now, some more interesting facts that you should be aware of. There are 159 million people paying into the system, and their employers pay into the system. So when you see your FICA amount on your paycheck, double it, because your employer is paying a like amount. 60 million people get retirement benefits. 19% of the population are receiving, 90% of that 60 million, 19% of the population receive disability benefits. 12% are receiving survivor benefits. And for 2014, the maximum money that you can earn and pay tax on and pay Uncle FICA is $117,000. However, that's for Social Security. There's no cap for Medicare, and depending on your income, there's also that extra success tax that you may have to worry about. Again, if I'm going too fast, let me know. I want you to just get a good overview, because you can look this up yourself. It's also going to be covered in the retirement planning class. You might get a test question that says, if you were born if you're 35 years old today, or if you were born after 1960 or 65, what is your full retirement age? And the full retirement age, depending on when you were born, starts at age 65 and goes up to age 67. For most baby boomers, it's going to be age 66. And then it adds 2 months. From 1955 to 59, it's going to add 2 months for each year past 66, and then after that, if you're born after 1960, it's going to be 67. However, there's a good chance they're going to have to raise that again to age 70 or 72, because Social Security was never designed to pay an income for 30 years. In fact, when it started in 1935, what you have to be aware of, maybe many of you aren't, is most people didn't live to 65. And if they did live to 65, most of the people were passed away by the age of 72. My grandfather died at age 82, and the week before he died, he was talking to me about how lonely he was because most of his friends had passed away. My grandmother passed away 7 or 8 years earlier from cancer, and he had 1 or 2 friends, and he said he's lonely. It wasn't a question of whether his cohorts were around. But today, the fastest growing segment of the population, not only in America, but in the entire world, are people over the age of 85. It is assumed that somewhere in the next 10 years, you're going to have 250,000 people over the age of 100. There are people that retire at age 62 to 65 that are going to get Social Security paychecks for 35 years. Are you aware of the fact that a married couple age 65, there's an 80 to 90% chance that someone is going to live to age 88. If someone lives to age 88, there's like a 90+% chance that person will live to mid-90s. So that means that if they started their full retirement at 66 or 67, they're getting 30 years of payments, and they may not have paid into it that amount of time. That's one of the problems with Social Security, is it's underfunded, and part of the reason it's underfunded is since the times of Lyndon Johnson and the Great Society of the 1960s, they've been borrowing money from the Social Security Trust Fund and not always paying it back dollar for dollar. You might get a test question that says, what is your full retirement age? That means, when are you eligible for the full benefits? If you were born in 53, 58, 63, or if you're 37 years of age. Take 5 minutes, figure this out for yourself, come back to it, because it's tested. Now, full retirement age means when you're eligible for the full benefit. If you delay the full retirement age past when you're eligible for if you delay taking Social Security past your full retirement age, you're getting a bonus of about 8% per year. Well, some people say take the money as soon as you can, because if you don't live long enough, you're never going to recoup it. Other people say if you don't need the money, wait, especially if you're going to continue working, because if you take the money at age 62 and you continue to work, you're going to lose dollar for dollar. You're going to lose dollar for dollar of benefits, or I'm sorry, $1 for every $2 of money you earn, so you might not really get the money. Take another 5 or 10 minutes and learn what these terms mean. Primary insurance amount, average index monthly earnings, delayed retirement credit, full retirement account. Your primary insurance amount is what is your benefit figured on. What's the index? Because let's face it, if you're 65 today, you might have been earning money in the 1970s, late 60s and 70s, where you might have been making 10, 20, 30,000 a year, which today would equate to a higher amount, so that's where the average index comes in. The full retired amount is when you're entitled to your full benefit. If you start before age that full retirement, you get a haircut. If you delay it past it, you get an 8% increase. How is it earned? You need 40 quarters or 10 years paying into the system. What many people don't realize is in 2014, if you earn $1,200 in a calendar quarter, that's one credit. Therefore, you need $4,800, and you can earn that in one day. So people that are seasonal can make their entire year credit during the summer season. People that are consultants or something, and maybe they get paid $5,000 for giving one speech, that's a credit. If you have domestics working in your house where you're paying them more than $1,200 in a quarter, you're supposed to deduct Social Security from their paycheck, and you're supposed to pay it as an employer. Be aware of that. It's tested. Be aware of the haircut. If your full retirement age is 67 and you start at age 62, you're going to get roughly 70% of what that full retirement benefit would have been. If it's 67, your full retirement age is 65. I'm sorry, if your full retirement age is 67, you start at 65, you're at 88%. If you wait to age 67, you're at that 100%. Be aware of the fact that you might be 65 and getting Social Security and eligible for Medicare. If your spouse is 62 or 63, he or she may still have to have their own insurance plan. Medicare only starts at 65 currently. Here it says, if you retire before your full retirement age and make over $15,120 as an individual, or about $34,000 if you're married, you're going to get a haircut. I knew somebody who insisted on taking their benefit, and I kept telling him he was making a mistake. He said, "You don't seem to understand. I have this loan I want to have paid off." I said, "But you're still working. And once you start that early benefit, that's what you live with for the rest of your life. You don't get to come back and get a mulligan." So he took this benefit, and he realized he was only netting like an extra $75 or $80 a month because of his income, and he wasn't able to pay off the loan the way he thought he was going to pay off the loan because he thought it was going to be additional money, and he would not listen to reason. Well, it didn't work out the way he wanted it to work out. Taxes. I talked about the Golden Promise. President Reagan, a Republican, President Clinton, a Democrat, both started taxing Social Security benefits based upon an index for inflation. An index for earnings. So the good news is, if you have only Social Security, you don't pay any taxes at all, but you don't have much income. The bad news is, if your income is higher, it can be taxed at either 50 or 85% of your income based upon how high your income is. Good news, bad news. Whoops, I'm sorry. What is subject to Social Security taxes? And it says here, again, if you're single and you earn $15,000 or $25,000 or $34,000, well, how is it going to be taxed? This is just some extra information. Is the total you can receive No. The total is not you can receive $117,000. It is what is your FICA taxed on, how much income. So if your income is $200,000, you're only paying FICA or Social Security tax for retirement and survivor benefits on the first $117,000, but you will be paying Medicare tax on all of the money. Does that clear it up? Thank you. I have about another 8 to 10 slides, and then we're going to be done. If you delay your full retirement age, you're increasing it by 8% a year. That's what your monthly benefit will be. This is just a little information. So if your income is under $19,000, you're going to get about 56% of your income replaced under Social Security. If your income is at $69,000, you're getting about 35% replaced. If your income is at the 117, you're going to get about 26% replaced. So as you see, the greater your income, the smaller the percentage of replacement. The other thing you should be aware of is there's a maximum you're going to be able to receive under Social Security, and that's somewhere around $2,500 to $3,000 a month. If you're earning more than $200,000 as a single or $250,000 filed jointly, there's an additional 0.9% that you have to pay in a success tax under the American Affordability Health Care Program. So that raises the cost for the employee, but not the employer for Medicare. For Social Security. And then there's, if your income is over $420,000, you're going to pay an additional amount of 3.8% of tax. So technically, if you're in the maximum tax bracket, that means you're going to be paying you're in like a 42% tax bracket. Also, remember, when you're talking about taxes, it's graduated on the marginal tax rate. So that doesn't mean you're paying 42 or 43% on all your income. It's only the income above that threshold. What people don't realize is your spouse is entitled to 100% of her benefit or his benefit, or 50% of your primary insurance amount, whichever is greater. They don't get both. So if the spouse's benefit, I am working with someone right now where the widow's income as a surviving spouse is $2,400 a month, but her own benefit would be like $1,800 a month or $1,700 a month. It's obviously to her advantage to take the spousal benefit. If, on the other hand, her benefit as an individual would be greater than 24, it would be to her advantage to take her own. What people don't realize is if you've been married for at least 10 years and your spouse has not remarried by the age of 60, that spouse is entitled to 50% of your primary insurance amount when they're eligible at age 62 or 65. And if you have more than one spouse, 3 spouses could be collecting as long as they follow the guidelines. People don't understand that. It won't be a test question on it, but it's just some trivia that I'd like you to understand, like to know. In December 2013, the SSA announced that same-sex married couples are now entitled to spousal benefits. My problem is I don't know how they're defining that because not all states allow for marriage. So I can't answer that. I'm just giving you something that was on the website. Social Security for 2014 went up by 1.5%. For the benefit. The downside was the Medicare was supposed to go up by a greater amount, but they backed that off. There are some years Medicare actually goes up, the Medicare premium actually goes up by more. The planner is frequently asked when the client should start taking benefits. I'm asked all the time. There is no best answer. There are some software programs that can help you figure out the optimal time. You have to look at the current rules that the Social Security Administration has for file and suspend, where sometimes, and I've had it happen, where Jack will file, suspend his payment because he's going to wait to age 70. Sally will take the spousal benefit that she's entitled to, and then when sometimes, and this is not clear, sometimes Sally can then go back and get her own benefit later on, but I think right now, once you start the spousal benefit, they're closing that loophole. Other benefits, there's a disability benefit. If you're fully disabled, we're going to be talking about that in session number 9. For a widower, there's a $255 once death benefit. It used to help pay for a funeral. Today it probably pays for the obituary and sometimes maybe. There's SSI money, which is administered by the Social Security. It's more extra compensation and welfare, but it's administered by Social Security. And you can go to this website for all kinds of calculations. It will tell you what is your benefit currently. You can register yourself, and you should. You can also go to this website, and there may be a way to figure out when you should take benefits. Or as I said before, certain insurance companies are now offering, and certain stock firms are starting to offer information. And there are actually some financial software packages that you can get or buy. Any questions on the overview? And again, this was only meant to be an overview. It was not meant to be everything you want to know about Social Security but we're afraid to ask. It was only meant to be an overview. Okay, if you have no questions, I'm going to conclude for tonight. Please remember to go to the chat, the discussion board if you haven't done it already. And if you want to start the discussion on what is it about money that's important to you, I'm going to give you a few more guidelines on Wednesday, so wait till Wednesday. Make sure you finish quiz 1 and work on quiz 2. Make sure you have your calculator with you next Wednesday night. I'm going to stop the recording. I will stay in the classroom in case anybody wants to talk to me